Hello, I am Greg Harris, President of Watson Title Services in North Florida, and welcome to part 2 of our series of videos that will provide an overview of the new settlement statement, now known as the closing disclosure, that will take effect for all mortgages written after August 1st, 2015. We know there are a lot of changes coming up, and we're here to help you understand these changes and how they will impact buyers, sellers, and their real estate professionals. This video is just one part of a larger series of training sessions you can access over at Watson Title Services of North Florida's YouTube page. That way you can view it and other videos as many times as you like or at a time at your convenience. At the end of the video and at the bottom of each slide, you will find our email address and phone numbers. If you have questions or would like clarifications in any of the points that I make, please reach out to us. And to help you in the course of watching the videos, if you don't already have a paper copy of the closing disclosure that I'm using as an example throughout the series, just drop me an email like you see on the screen here, gregharris@watsontitle.net, and I'll send you a PDF. Let's start out with an overview of page 2. Just like we did with page 1, we're going to take this apart section by section. Before we start doing that though, just give it a quick look over. You'll notice it really isn't that different from what we are using now. So as I mentioned before, this will not be a radical departure. There are a few differences, but nothing out of hand. In closing cost details, the first section is loan costs, and you see the details in 5 columns. Items that pertain only to the borrower, items paid at closing, and those items paid after closing, what we often refer to as POC or paid out at closing notations, will now go into columns. Seller's charges paid at closing, paid before closing, and paid by others fill out the other columns. All columns and subcolumns must be reported. In this section, loan cost will include all services that are required by the lender that are unshoppable. And starting off, points must always be in cell A1, even if 0. The paid by others column will be used if any third-party fees that are attributable to securing the loan. For example, if there is a third-party originator that the buyer pays a fee to, then it will show in the others column as paid by others. Now for section B. This section lists any services that were not shoppable or were shoppable, but the consumer selected a third-party vendor from the provider list, or the service was provided by an affiliate of the lender. Moving on to the third section, section C. This is where the services the consumer could shop for are listed, as long as those providers of those services were not on the previously mentioned lender-supplied provider list or the service was provided by an affiliate of the lender. Those are the items that again need to go in section B. Any fees related to title services must begin with the word title. This is also a good place to point out something that's kind of an interesting feature of the new closing disclosure. All fees listed must be listed in alphabetical order, as you see in this example. If a fee is added later on, it just can't be put at the bottom. It will have to be put in its appropriate alphabetical order. Because of this, attention to detail for both those preparing and reading the closing disclosure will be essential when changes are made. You just can't look at the bottom for any last-minute changes. Another item that will help with transparency. The agent and underwriter split will no longer have to be broken out. And for those that have been in the business for a long time will welcome this additional change. Itemization is back. No longer will fees be rolled up, causing confusion for everyone in the process. All fees will be itemized in the appropriate section. With the good though, there's a bit of confusion thrown in as well. That we're going to just have to learn to explain to each other and explain to our customers and just have to keep rolling with it. We're going to cover some of those little challenges right now. The problem is the requirement that the federal government has created nationwide does not work with all the different jurisdictions and traditions that we have. And the change that we're going to go into that impacts us because we live in Florida affects 21 states overall. And it involves the simultaneous issue of both the owner's and the lender's policy and how those costs are required by the rule to be put on the settlement statement. The full value of the loan policy, as if it was standing alone without the simultaneous issue of an owner's policy, will have to be listed in sections B, R, C. Then the owner's policy premium, again, as if it was a standalone policy without simultaneous issue with the loan policy, will be listed in section H, a section we will cover later on in this session. What will be done is that we will have to add in the simultaneous issue premium to the owner's policy premium and then subtract out the loan policy premium listed earlier in sections B or C. I know this seems like an unnecessary complicated step, but it is how the federal government via the Consumer Financial Protection Bureau, the CFPB, have written the rule. If explained properly, though, it is less complicated than it may appear the first time around. However, the errors that this creates in the closing disclosure, anytime the seller pays a portion of the owner's policy, which is the majority of closings in Northeast Florida, must be corrected. The title industry and the 21 states impacted by this rule have been working for well over a year to have the CFPB understand this problem, but they have had no luck at this point getting them to understand what the rule will do to add confusion to the consumer and everybody else involved in the transaction. As for now, the CFPB will not bulge. We'll just have to find a way to work around the problem. Let me give you an example for those like me who work better seeing how it functions with numbers. For the first example, I'm going to keep to round numbers. For instance, in this example and the example you see on the closing disclosure that we're going to use throughout this series of videos, our simultaneous issue rate at Watson Title is substantially less than the $400 used in this first example you'll see, but because it's what's on the copy that you have, we're going to go ahead and stick with it. Then after we do this example, I'll actually show you one that it would look like for a closing in our area outside of Nassau County. But anyway, let's get started and look at the facts of the example that we have. The facts of the contract state that the seller will pay the owner's policy premium of $1,400 and the buyer will pay the simultaneous issue rate for the loan policy of $400. In theory, if there's just a loan policy by itself, it would cost $850. Here's what the rule requires in action. The owner's premium of $1,400 by the rule requirement, from that $1,400, we have to add in the simultaneous issue rate of $400, bringing the total to $1,800. Then, the rule requires us to subtract out the theoretical standalone policy value of $850. That shows on paper the owner's policy costing the seller $950, $450 less than the contract requires. On the buyer's side, if you recall, if there's a standalone policy, it would be $850 paid by the buyer, but they're not getting a standalone policy at all. They're getting simultaneous issue of both policies. But that $850 cost of a standalone loan policy is $450 above what the buyer should be paying with a $400 simultaneous issue as per the contract. As you can see, now everybody's messed up. Cash to close is inaccurate by design and required by the rule in both the buyer and seller columns. Here's another example, but this time I want to use actual numbers for a closing with Watson Title Services North Florida, where the seller pays the owner's title insurance. So if you have a paper copy of the entire closing disclosure, just look up here because the numbers are going to be different than the previous example. But in this case, we have a property with a sales price of $300,000 and a loan value of $240,000. In this case, a standalone policy for $240,000 would cost $1,275 for a buyer, but if issued simultaneously with an owner's policy, it would only cost $175. Due to the CFPB rule, the buyer's figure appears $1,100 more expensive than it actually is. For the seller in this example, an owner's policy for a $300,000 sale is $1,575. However, the rule states that we have to add the cost of the simultaneous issue, then subtract out the theoretical cost of a standalone lender's policy, given a figure in the end of $475. The seller's figure appears to be $1,100 less expensive than it actually is. Well, how do we fix this? Each state is working out the best way to square this circle, as the federal government, via the CFPB's rule, is forcing settlement agents in these 21 states to break out costs in an inaccurate way on the closing disclosure. And in some ways, and in some states, it is contrary to state laws and regulations. There will be a fix for this in time, and details on Florida's fix will be covered in a later video, so stay tuned. Don't worry about it for now. For now, let's keep plowing through page 2, and let's move on to section D. Section D is really rather simple. It's just a totaling up of columns A, B, and C. One thing you may have noticed as we were reviewing each section itself totals upwards in the column for that section for the buyer. The seller, however, does not have benefit from section by section totals. Seller's totals will be found at the bottom of each page. Next, in section E, are taxes and government fees. This is where you will find your recording fees and transfer fees. Any fee or tax that is required to get documents from the closing on record. There are some interesting items here that should get your attention. Only the deed and recording fees will be itemized. All other fees will be totaled in the columns, but not itemized. Transfer taxes will be itemized with the entity that is assessing the tax, even if the payee is different. Section F contains the prepaids, those items that will come due before the consumer's first monthly payment. Homeowners insurance, PMI, prepaid interest, and any property taxes that may be due, again, prior to that first mortgage payment. It doesn't matter if they're being paid by the buyer or the seller. In what was formerly the 1000 block of the 2010 HUD-1, Section G is where the creation of the escrow account is shown, along with the aggregate adjustment. Section H is what used to be the 1300 block of the HUD-1. This is where you will find other costs that were not required by the lender to be on the loan estimate. For real estate agents, mark this down. This is where you will find your gross commission. So go to Section H first, because that's what I did. I was in sales. That's where you're going to want to go to find out what the gross commissions are. You'll also find here your HOA, pest, lawn, or any other such fees. This is also where you will find the owner's title insurance premium we mentioned early on. This is where you'll find one other CFPB rule twist. If the consumer, the buyer, is paying the owner's title insurance, which isn't the standard in our area outside of Nassau County, or if the contract reads as such, then in parentheses needs to be the word optional. So if the consumer, the buyer, is paying the owner's title insurance, optional needs to be next to it. If the seller is paying the owner's title insurance, then that optional doesn't have to be there. This, along with simultaneous issue, is an ongoing point with the industry to discuss with the CFPB. because in our opinion, this does not add simplicity and clarity to the document. So stay tuned. If by August 1st, it appears that the optional will still be there, I'll go ahead and put out a video with some scripts real estate agents can use to make sure that the buyers know why they want to have owner's title insurance. But for now, let's keep moving through page 2. Section I sums up everything from sections E, F, G, and H. The last section on page 2 is section J. This totals up the closing costs together by adding up the subtotals in sections D and I. What you'll also see here are any lender credits, either agreed upon credits or what is now called tolerance cures. Previously, you may have heard them called tolerance violations. We don't use the V word anymore. They're now called variations that are corrected by tolerance cures. So if you're used to hearing tolerance violations, you're now going to hear tolerance cures. And that completes page 2. If you haven't already, make sure and subscribe to our YouTube videos so you can catch the entire series when they're published. As always, everybody here at Watson Title Services of North Florida appreciates the time that you're taking to get up to speed on the new closing disclosure. And if you have additional questions, or again would like a clarification on any of the topics we bring up, please feel free to write us or give us a call. Thank you very much for taking time, and I hope you have a great and prosperous year.